Hi there, welcome to Trading Day. Let's get to the big stories we're bringing you from our newsroom. Ottawa has approved a major natural gas expansion in British Columbia. The government says the $4 billion Sunrise program will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demand in the province. And the government also says it will support LNG exports. Canadian retail sales in February rose less than expected. Statistics Canada says overall sales increased 0.7%, and that was below forecasts of 0.9%. Motor vehicles and parts were the top performers. The data suggests that consumers are still spending, but cautiously. U.S. Attorney Jeanine Pirro says she is dropping her investigation into Jay Powell, the Fed chief, over building renovation cost overruns by the Federal Reserve. In a post on social media, Pirro says the investigation was finished, but she warned she would not hesitate to restart a criminal probe should the facts warrant doing that. Jay Powell's term as Fed chair is scheduled to expire May 15th. President Donald Trump has nominated former Fed Governor Kevin Warsh to replace him. And there is the TSX. It is marginally higher today, still down from its record highs of a few weeks ago. Let's have a look at the U.S. markets, because both the S&P 500 and the NASDAQ have hit new highs today. You can see the NASDAQ not far from breaching 25,000 for the first time. Lots going on in tech today. Intel has finally surpassed its dot-com era peak. It delivered second quarter forecasts above estimates. Let's get more on Intel and everything in tech. There's so much going on. Liz Miller joins us now, president and founder of Summit Place Financial Advisors. Thank you very much for joining us, Liz. Intel, it seems strange, doesn't it, that investors are apparently cottoning on that the traditional central processing unit chips are important for AI as well, but that seems to be the case.
Yes, and Intel is participating in that. I think a lot of analysts are skeptical of this huge run today. Very proud of their quarter where they surprised after years of struggle. And even with their positive outlook, they still have challenges ahead meeting demand, which has always been an issue for Intel over the past decade plus. You noted the stock has exceeded its dot-com peak. You know, it's played with that number since around 2018 a couple times, but consistently moved lower. The CPU area is yet another shovel in the infrastructure of building out AI. Intel will certainly benefit along with other companies. I'm in the camp today that I'm a little skeptical with the stock reaction today. We'll be watching over the next quarter or two to see if they can meet the demand that they're seeing and what that looks like on an ongoing basis for them.
Because Intel was seen as an also-ran, wasn't it, for a lot of this AI build-out?
Yes, Intel has been seen as an also-ran, and not specifically to the AI build-out. If we rewind even post-COVID, Intel couldn't meet demand then, and even openly said it would be years before they could build enough capacity in the United States to meet just general need for their CPUs. Now they have another wave of demand, and there's excitement for that demand. It's just not clear that they can execute. And execution has been their biggest challenge, again, for up to a decade now.
Quite a bit going on, obviously, in tech. The Wall Street Journal had a story today about how Oracle's massive borrowing is causing indigestion on Wall Street. The banks have lent them billions of dollars, and traditionally the banks would lay those bets off, try to spread the risk, but they're having trouble doing that. Oracle has now borrowed so much. It looks like Oracle is kind of the poster child for potential overspending on AI.
I think it's going to be a while till we're sure where the risks are with AI investment. It does ring a little true to the dot-com era when so much money was being thrown into the trend. We're seeing a lot of money come into this trend. A lot of it is outside money, and thus these companies are generally having no trouble raising capital in the public markets. Remember, these are technology companies that traditionally had very low debt levels because they had no need to borrow. They had such high cash flow, it was easy to reinvest in their own capital. Now we're seeing many of the tech leaders building up debt on their balance sheet. What's different from now when we look back to that last trend, it's easy to think the dot-com bubble when we had another sea change in technology. These are all now established companies. They have cash flow that has been proven over a number of years. If the trend right now mitigates, if it slows down, they still have underlying businesses that have done well. So I do think it's worth watching these credit trends across the top tech companies, but I don't yet see the warning signs.
You have a couple of stock ideas for us. Start off with LH in New York, LabCorp. What do they do?
Sure. I think that you have to think about these suggestions in the context of the market as a whole. We're enjoying an incredible rally from tech right now, all part of that AI trend. And I do think that's what's letting the U.S. markets be a bit more resilient than some of the other markets in the face of Mideast uncertainty. When technology trends are dominating in the world, U.S. markets always are going to do very well. That does right now bring some extra risk. So what I'm talking about when you look at a LabCorp and my other suggestion here is we're talking about adding even more broader diversification to your portfolio. Yes, keep all those tech names, but maybe think about something like a LabCorp. In the healthcare industry, very consistent demand for lab services. Very well positioned going forward and at a great valuation right now for forward earnings.
And you have an idea in healthcare technology. Danaher, they're a maker of equipment of broad applications. They're kind of central to the medical system.
Yes, central in biotech research as well as a number of areas. So another company with some really consistent demand in healthcare. They just had a great quarter that exceeded expectations, really setting them in a good position for the future. They made an acquisition in February that adds even more exposure to AI monitoring within the biotech research and diagnostic research that goes on. So another company I think that's worth looking at to diversify your portfolio across whatever volatility may or may not be ahead.
Liz, thank you very much indeed for joining us. Liz Miller, president and founder of Summit Place Financial Advisors. Have a great weekend, Liz. Really appreciate it.
Thank you.
Coming up, we've got an upgrade for Magna. Are prospects brightening for the Canadian auto sector? That's ahead. Let's focus now on the Canadian auto parts sector, mostly though on a company that has a global presence, Magna International. It has been upgraded to buy by Scotiabank. Let's get more from the analyst, Jonathan Goldman, a diversified industries analyst at Scotia Capital. Jonathan, thanks for joining us.
Good afternoon. Thanks for having me.
A fascinating piece of work. We keep hearing about this divide in society between the higher income and the lower income people. You reckon the auto market, certainly in the US, is being driven by wealthier households there. They are accounting for a hefty chunk of vehicle sales.
Yeah, that's right. So, I mean, we upgraded the stock and effectively the sector today. Pretty out of consensus call, as you've seen all the headlines of discretionary spending may be under pressure due to inflation and oil. We probably fell into that bearish camp for the last year plus or so. It was on the higher pricing. The average car price in the U.S. is $50,000 U.S. The average monthly payment is $900. And we thought that would be a headwind to demand. And we've kind of come around to the fact that the volumes have been resilient. And one of the key reasons, as you point out, is the wealthy consumer, the wealthy household is actually supporting the auto sales, and they're driving this sort of level of volume that's sustainable. And the point in there, and also this is part of driving the prices higher, is the wealthy household, the more affluent consumer tends to go for the higher priced, higher content vehicles like the SUVs and the pickup trucks rather, which benefits Magna and the other North American suppliers.
That's interesting. Magna has a pretty decent franchise in SUVs and trucks.
Definitely, for sure. They're probably the leader. You mentioned they're a global company. They're the top 4 supplier in size in the world. They're number 1 in North America. And Magna actually manufactures every single GM pickup truck frame across North America. That's 1.3, 1.4 million trucks. So when you look at Magna and some of the other North American suppliers, they are going to be the direct beneficiaries of any sort of tailwind that happens in the US or Canada.
What about Linamar, our other great auto parts maker? What is your verdict on them?
So we left our rating unchanged on Linamar. We're still hold, and it's the main reason there is their exposure to industrial. So that's their access segment with the aerial lift platforms and the ag market. So they're going to definitely benefit, as we believe, with Magna on the auto space. But the issue with Linamar, and they have a great franchise in both those platforms, is you may have saw last week some of the other headlines about incremental headwinds, from S-232 steel tariffs.
Okay.
Hit some of the power sports makers. And until now, Linamar was unscathed, and they still are, relatively speaking, in the auto business. But they do import product into the U.S., the agricultural equipment, the platform lifts, and that it will be incrementally impacted by the steel tariffs. So they probably can do some stuff to mitigate that, but you'll probably have a lag effect, and you could see a hit in the short term.
What about this oil shock, Jonathan? You say the numbers historically indicate that jobs are a better predictor of auto sales than oil prices?
We were just as surprised as you. I mean, oil is an input to everything in society. It raises the price of everything. Inflation is not good. It reduces your spending dollars. It obviously delays rate cuts. So we did do a lot of deep dive work into the data, and we found that oil prices alone do not impact auto sales. It's, as you mentioned, it's jobs. Obviously, if oil prices do stick around and they're longer for higher, you do get into a situation where the economy slows, and that does impact auto sales. But if you're looking at 1, 2, maybe even 3 months of oil prices at these levels, nothing much to worry about. And I guess our view is if oil could stay at 100 or below $100, you're not going to see much demand destruction in the auto industry. As I said, it's jobs, and those have been pretty resilient as well. Consumers are not, super optimistic, but they're still spending. And, it kind of goes back to my earlier comments about the wealthy consumer, and they're kind of more independent or agnostic of economic trends.
I guess we should remember fuel cost is only a portion of owning a vehicle. It's always, I don't even want to think about how much it costs to run a car. Insurance, repairs, parking, you name it.
You've seen inflation across the board, even the collision repair, the cost of insurance. But you did mention it's only one part of the car. And I think if you were to see an impact, on a near-term basis of the oil price, it would likely be a mix shift where consumers trade down to smaller, more fuel efficient cars. Part of the mix is being shifted by the wealthy consumers, as you said. But eventually, you need to replace your car. They have a built-in depreciation. They break down. So you may see people go for smaller cars. And the other thing you could see, too, is OEMs remove some of the content. So you get kind of same dollar value, but a little less car for your buck.
Just update us on electric vehicles. Obviously, the growth in sales has been disappointing. What about the States? Are we seeing, is hybrids, is that the growth area for people rather than pure EVs?
That's a really interesting question, right? So we did see the industry kind of fall off into sort of this upwards curve of EV adoption, started in 24, 25, and it really hit the wall, when Trump removed the EV tax credits in the US, and you kind of saw demand fall off a cliff in December. We've kind of, I would say, we're back to steady state. We're growing, but just not at the same rates we were. What's interesting is these higher oil prices does make people consider and sit down and do some of the math on whether the savings that they can generate from an EV does make sense in terms of going with what is usually a typically more expensive unit. So I would say demand is not back to the levels of EVs that we were 2 years ago, but definitely interest has peaked, I would say, in the last month or two.
Jonathan, thank you very much indeed. Jonathan Goldman, diversified industries analyst at Scotia Capital. Coming up, we got this week's episode of Bloomberg Docs. We're diving into Anthropic's Mythos AI model. It's sparking fears that the technology may be advancing faster than it can be safely deployed. That's ahead. Anthropic's latest model in AI, Mythos, has sparked fears that the technology may be advancing faster than it can be safely used. But of course, all the row may benefit Anthropic as it sees potential valuations now approaching $800 billion US. Let's get more in Bloomberg's weekly doc.
If you look at the AI sector landscape more broadly, what you've seen is OpenAI's early dominance being challenged increasingly by Anthropic.
Anthropic is drawing investor interest at a valuation of $800 billion or higher,
making it close to, if not the most valuable startup in the world.
Turbocharging the hype is Anthropic's latest model called Mythos.
Only a small number of companies outside of Anthropic have access to it, and on a limited basis.
This limited release has been dubbed Project Glasswing, and all the participants include a who's who of Silicon Valley.
We know that Apple, Google, Palo Alto Networks, CrowdStrike, the Linux Foundation, Amazon, that are part of this Glasswing project. It's a highly unusual arrangement. These are fierce competitors who are trying to get the best model out there. And Anthropic is not only showing them sort of some IP that hasn't been released yet, they're allowing their competitors to potentially criticize some of the work that they did.
The unorthodox rollout has generated a lot of publicity, and already there are reports of unauthorized users accessing the model.
This is terribly basic cybersecurity practice 101 that was missed here.
We have been hearing about this theoretical threat that AI poses to cybersecurity, and what Mythos has proven is that that threat is a reality.
There are big worries that this, if it falls into the wrong hands, it could essentially lead to some of the greatest cyber risks that humanity's ever faced.
With massive potential for havoc and the stakes so high, is tech's era of move fast and break things finally over?
Well, Bloomberg has learned that the Treasury Secretary Scott Bessent and Fed Chair Jerome Powell summoned Wall Street leaders to an urgent meeting on concerns that the latest AI model from Anthropic will usher in an era of greater cyber risk.
Although the discussions were, of course, private, the gist of the meeting was, hey, banks, better start testing this thing now before it's too late.
The US banking sector is obviously systemically super important to the US economy and the global economy. Trillions of dollars go through these banks' pipes every single day.
The threat Mythos poses is twofold.
It has the ability to detect vulnerabilities in basically every web browser, every computer system that it's so far been tested on.
That could be finding issues in a lot of the web services we use, financial payment services, operating systems like on iPhones and Android.
So you're talking bugs, potential holes in infrastructure that these banks might have been sitting on for years or decades and maybe haven't patched up that might be vulnerable to outside hackers.
But Mythos doesn't just find bugs. It knows how to take advantage of them.
You would have to kind of be able to direct it in some way, but largely it was autonomously able to go and find bugs and exploits and come up with a plan on how to actually take action on them and potentially do some harm to the product that it found the flaw in. It lowers the playing field in terms of the skill set that you need, the time it takes. You could do this en masse, and also the cost. You've seen historically that nation states might spend years and a huge amount in financial investment in creating an army of military hackers who are extremely experienced, great coders. Having access to something like this reduces the need for that at all. It's not just nation-state hackers too, it's financial career criminals, these criminal gangs that operate all around the world.
The risks don't stop in the US. We've also had the central banks of Canada, now also the UK as well, calling companies together to talk about Mythos and the risks that are posed by it.
The engagement that I've had from CEOs in the last week in the UK has been significant.
Fear of dangerous AI and its consequences have been with us for decades and is ubiquitous in popular culture.
I'll be back.
But science fiction aside, the ethics of how to deploy AI is rapidly becoming the loudest debate in the industry, and it's central to Anthropic's founding.
A group of early OpenAI employees left to start Anthropic with the goal of building more advanced AI systems, but in a safer and more responsible way. And that has really been their brand throughout their history.
The company's MO has led to a showdown with the Pentagon, which contracted with Anthropic in July of 2025.
Anthropic is really pushing back at two key points. One, to have more clear guardrails preventing AI from being used to aid in mass surveillance. And then the other being AI used to basically use autonomous weapons. For the Pentagon, the argument is that no private company should basically be meddling in the Defense Department's affairs. No private company should be telling the Defense Department and the armed forces how to use technology on the battlefield. Anthropic is now in court suing the Pentagon over the Pentagon's decision to declare a supply chain risk, a very rare designation usually reserved for foreign adversaries.
So while the Department of Defense seeks to blacklist Anthropic, the Treasury and White House are pushing to expand access.
Suddenly, it feels like parts of the Trump administration are waking up to the reality that they probably need to work with Anthropic. There's really no regulatory framework around AI. At the end of the day, a private company made a choice, seemingly on its own, to withhold its model from wider release. But nobody told it to do that. That is probably the ultimate indictment on the current state of the regulatory framework, at least in the US. But longer term, if you're trying to establish AI supremacy in the world, it may not be the best idea to cut off the company that now increasingly seems like it's at the vanguard of US AI development.
A flip side to all the caution around Mythos is the idea that hamstringing its rollout actually amounts to a brilliant marketing campaign.
There's no way they made an AI too powerful to release.
We're about to be victims of doom marketing.
That helps them raise capital, and it gets people pretty hyped up.
With Mythos, I think you're seeing a company that genuinely is concerned about the capabilities of its models. At the same time, is it in some way self-serving to show the world, we've built something incredibly powerful, but we just don't want you to have it?
If it's bait, then from a Wall Street perspective, it's been taken. Take a look at the S&P 500 and NASDAQ. A Bloomberg index tracking AI-related companies continues to outperform both. And that's before AI darlings like Anthropic and OpenAI have even gone public.
There does appear to be a race to go public right now in the AI sector. The most recent reporting that we have says that Anthropic could go public as soon as October. OpenAI is also widely expected to be vying for public offering as soon as this year, and Elon Musk's xAI might beat them both to the punch after merging with SpaceX, which is set to go public as soon as June.
But the uproar on Wall Street adds pressure to prove profitability.
OpenAI initially went after consumers. OpenAI's ChatGPT now has more than 900 million weekly users. That rivals the reach of a lot of large social networks. Anthropic took a different route. Their core business was enterprise customers.
This brings us back to that meeting with the banks.
Banks already spend vast amounts on their technology, and that's one of the reasons that companies like Anthropic and OpenAI want to partner with them already, right? These companies are already investing really heavily, both in their own internal AI tech, but also in the contracts that they're signing with outside vendors like Anthropic.
Spending on cybersecurity just keeps growing. Expenditures are expected to reach $300 billion by 2030.
Where Anthropic and OpenAI have really excelled in recent months is building tools that automate the process of writing and debugging code. Now, Anthropic, OpenAI, and other privately held firms are trying to sort of prove that their technology is not just useful for software developers, but that it's broadly useful for scientists, for financial firms, for creatives. That's still a work in progress. The same technology that might one day lead to a scientific breakthrough will sometimes struggle with basic math. Cybersecurity has emerged as another interesting and key use case here, but it's kind of an offshoot of coding. So with Mythos, they're tapping into that hype.
In their own words, the same capabilities that made AI models dangerous in the wrong hands make them invaluable for finding and fixing flaws in important software. The Mythos story is about trying to fight fire with fire. While it creates opportunities for havoc, it also promises a stronger rebuild, all while opening up a lucrative revenue stream in the meantime.
Up until now, the main conversation about AI has been what's going to happen to our jobs, because so much of this technology has been to streamline back office processes, find efficiencies. But now the worries are not just about job safety, they're actually about system safety and security safety. And that takes this to another level.
Coming up, Ottawa says it wants secure, independent access to space, a Canadian launch site. We are going to speak with one CEO working to make domestic rocket launches a reality. We'll be right back. Chinese exporters have started raising prices as the Iran war drives up input costs for certain goods. Companies say rising expenses for plastics and other oil-linked products are forcing them to pass those increases along. This is after years of cheap and cheaper Chinese exports helping to hold prices down. Economists warn this shift could start adding pressure to global inflation. Shares in Procter & Gamble up about 2%. The company beat sales expectations in its latest quarter, driven by growth in the beauty category. The consumer goods giant saw the highest organic growth in more than a year, and this may signal steady demand for everyday products. Now, P&G also stuck with its outlook for the current fiscal year. However, it is now projecting higher commodity costs. And yet another artificial intelligence story. Canadian AI player Cohere has signed a deal with Germany's Aleph Alpha in a bid to create an independent alternative artificial intelligence company. The companies say it will function as a transatlantic AI powerhouse anchored in both Canada and Germany. Now, they say that a German company, Schwarz Group, which controls the Lidl grocery chain, will invest about €500 million as lead investor in an upcoming financing round. TSX pretty flat today as we round out the trading week. Let's have a look at the US markets, because we did see both the S&P 500 and the Nasdaq hit new record highs today. Canada is looking to build its own domestic space launch industry. Ottawa wants greater space sovereignty. And of course, there's advantages, in theory, to independent access to space from the point of view of national security, research, and commercial development. So the federal government has committed $20 million over 10 years to a would-be builder of a spaceport in Nova Scotia. Let's get more from Stephen Mathieu, the founder and CEO of Maritime Launch Services. Stephen, thanks very much indeed.
It's certainly my pleasure. Thank you.
Tell us what your plan is. You would like to build a launch platform, a spaceport in Nova Scotia?
I think I would phrase it as our building, not like to build. We've been at this for a number of years, de-risking this initiative and working with the province on getting through all the environmental and provincial compliance pieces. We've done some initial construction out at the facility and actually have successfully conducted 2 suborbital launches. But this recent measure and commitment from the government of Canada to lease a pad from us has certainly invigorated us to accelerate the activities and keep the construction moving as we really just kicked in again with the season here a couple of weeks ago.
The National Post did a story on you, sounded a skeptical note. All you've built so far is a gravel road and a concrete pad.
That's one has to start with a gravel road and a concrete pad to be able to put rockets on top of it. That is how any and all projects of this kind begin. We are at our heart an infrastructure project that is really hosting rockets to come here, intended finish, and use our facilities. We've got agreements with Reaction Dynamics in Montreal, of course, D&D. As a user as well. We've got no less than 7 other clients that are vying for these other 2 pads that we're developing. We're really thrilled with the activity to date. And it really is about delivering a sovereign launch capability for Canada. At the end of the day, we have to have the ability to put our own satellites into orbit.
One of your launches, though, so far was just a student project, wasn't it?
Oh, it was, but there is also one that really demonstrated the tenets of the NATO Starlift program this last November. NATO Starlift is a program that offers Canada's spaceport to our other partners and allies within NATO to be able to bring rockets, satellites, and launch vehicle together. We demonstrated that in November with T-Minus Engineering based in the Netherlands. It was a great training exercise, but it was also a demonstration of what we as Canadians can provide to our allies as well as developing our own sovereign launch capability.
Generally, launch facilities are located at low latitudes because apparently the Earth is spinning more rapidly to other celestial objects at those lower southern locations. But you say Nova Scotia carries important advantages?
Oh, absolutely. When you look at where the satellites are being placed into orbit, now polar and sun-synchronous orbits, meaning north-south, are much, much more important. And inclined orbits, so stand at the coast of Nova Scotia and point to Africa, that inclined orbit is super critical to where these constellations of satellites are going into orbit. Think of Starlink and Lightspeed and others. They need to be 1,000 kilometers from Earth, and they need to be circling the Earth in a different direction than being close to the equator.
So the deal is over $20 million. You will get, over 10 years, you get $20 million from the Canadian government. Can you tell me how much other capital have you raised to date?
To date, we've brought in well over $30 million, including an investment from MDA Space last year, Export Development Canada, and the seed funding from our backers to de-risk this initiative to get it to this point of success.
And when would you hope to actually have your first launch? What's the plan there?
I assume you mean orbital launch, since we are continuing to do suborbital launches on a fairly regular basis.
Orbital launch, yeah, sure.
Yeah, we've got suborbital launches scheduled for twice more this year. Working with Transport Canada and Nav Canada, and now that Transport Canada has announced their regulatory framework commitments, this is really, for us, the final piece of the puzzle. We've got the regulations, we've got the customers, and we have the financing. Our goal is to really complete the activation of the facility, integration facility, launch control center, the pads themselves that are being developed, integration facility for satellite test and checkout. All of that will get completed by the end of 2027 with that first orbital launch, hopefully in that time frame or early into 2028.
Right. You've been going since at least 2016, I believe. So after almost a decade, only a concrete pad is all you've achieved?
I would say we've achieved a great deal more than that. Certainly, we started this idea with a launch vehicle based in Ukraine that has huge heritage and capability, would deliver for us a class of rocket and capability that we need absolutely still today. But getting through all that environmental work and all the compliance pieces, and certainly we've had our headwinds associated with COVID and the war in Ukraine that we have stuck with it and worked through, and now feeling a little bit of tailwind because of the need for sovereign launch because of the geopolitics changing in that other direction has really helped us move things forward.
Thanks very much, Stephen. Really appreciate it. Stephen Batcher is founder and CEO of Maritime Launch Services. Coming up, we're going to check in with Bloomberg's Canadian finance reporter, Christine Dobby. She's got this week's edition of the Bay Street edition. I like this. Apparently, if you are traveling with the Prime Minister on a plane and you plan to get a snooze, don't sit near Mr. Carney. You'll get no rest. Canadian politics and Bay Street have rarely been this closely linked. Mark Carney's government is leaning heavily on CEOs, deal makers, and former bankers to push big projects, speed up decisions, and sell Canada to the world. Bloomberg's Canadian finance reporter Christine Dobby has more in her weekly newsletter called Bay Street Edition. Christine, thanks very much. Before we get going, we've heard before that Carney can be a hard taskmaster. You have to be formally dressed. You have to show up for meetings on time. I guess that's pretty normal. But apparently, if you're traveling with him, he's relentless. He doesn't sleep much. And if you want to get a nap, try to hide at the back of the plane.
That's right. My colleague Brian Platt, who I wrote this story with, he's spent a lot of time the past few months circumnavigating the globe with Carney. And, he's had some firsthand encounters with people who have, said, if you want to get any sleep on the plane, you probably shouldn't sit near Carney because he's working around the clock. And it's also the kind of thing where he wants people to have answers right away. And we get into this in the piece, but it's a bit of a private sector approach to government. He doesn't want, layers and layers of bureaucracy. He doesn't want a briefing note that's gone up a chain to be approved. He wants to call people up and say, what's going on here, and get an answer right away.
So if you're sawing logs two seats over, he's not going to love that. You talk about just this plethora of former business types, CEOs, former deal makers on Bay Street who are advising him. And this is in stark contrast to the previous Prime Minister, Mr. Trudeau.
That's right. So at first we were sort of joking in the office that this was the bankers who run Canada. But there are more people than just bankers. Some of them have also run large pension plans or energy companies. But what's sort of common across some of the people that Carney has put in to run key elements of the government, like the Major Projects Office or the new Defense Investment Agency, or even the Public Service itself, or the Natural Resources and Energy portfolio, they're all very senior business people. They've either been in finance roles or worked in pension funds or, like I said, energy companies. They know people around the world. They are familiar with the people who are making big decisions about spending money. And that is the idea, is to attract money to Canada. We've been talking about this nonstop, right? And so part of Carney's plan is to enlist these people and help get the message out that Canada's open for business, essentially.
I'm old and bitter, but isn't this the same business crew that have helped Canada post dismal productivity growth for the past decade?
Yes, it's a small corporate community, isn't it? I mean, so when we talked to business leaders for this story, we heard a lot of Well, it's a 180-degree pivot from the Justin Trudeau administration, and a lot of business leaders felt ignored or even scapegoated under that administration. There's a sense that certainly the business people think that Carney is listening to them more, the Carney administration is listening to them more, and saying all the right things about putting conditions in place that might improve business productivity. I don't think there's ever going to be a silver bullet to, we'll probably be talking about business productivity by the time you retire from your next career.
That's right. Yeah, that's right. Yeah, I don't know. I'm torn. I want to go into maybe a janitor at a school or a factory. I love fixing things.
Why that?
I know. I just like the idea of maintaining things and ensuring the cleaning. No, I'm joking. That's a tough job being a janitor. Yeah. Everybody coming to you complaining all the time.
Totally, yeah.
Christine, thanks. And I've really enjoyed these Friday segments discussing your news. Christine Dobby,
thanks, Andy.
A Bloomberg Canadian finance reporter. We're going to take a break. Ottawa approving a massive natural gas investment by Enbridge in Western Canada. Enbridge is planning a multi-billion-dollar expansion of its West Coast natural gas pipeline system. It's been approved by the federal government. Let's get more from Bloomberg's Robert Tuttle. Robert, thanks very much. What's the important thing to remember here?
Well, this marks the first really major energy project that was approved by the Carney government. As we know, Carney has made an emphasis since he assumed office a year ago of trying to push forward projects, major national projects, quicker, facilitate energy development, and ultimately, try to diversify away from dependence on the U.S. Make Canada more competitive. Today, Enbridge said in a press conference, Matthew Ackman, their head of their gas transmission, said that this was an improvement over past Canadian government approval processes, but he said there's still more room for improvement. Things should move faster. The U.S., he said, is moving faster than Canada, and a lot of investment, including by Enbridge, is being driven south of the border because of that.
Right. Although pipelines do face fights in the U.S. as well, but it is interesting. The government anxious to speed things up. And you say this is the first major energy project that the federal government has greenlighted.
Yeah, that was. I mean, of this size, certainly.
Sure.
Of this size, $4 billion. Yeah. It'll add 17% to the capacity of that western gas system, a pipeline system that runs from the Montney Formation up in the northeast of BC down all the way to the U.S. border and actually supplies gas down there to the Pacific Northwest. But it will also help provide supplies for the Woodfibre LNG project. And one of the things that was noted today in the press conference was that, there's a real demand now, of course, for LNG after the disruption caused by the Iran war of Qatar's LNG. Canada will need more gas transmission to supply LNG, both greenfield and brownfield projects. Pipeline projects to supply the LNG that the world's going to need in the future, and so there seems to be more expansions on the horizon. This is just the first that's been in the works for a while, but there'll be more in the future.
Robert, thank you very much indeed. Bloomberg's Robert Tuttle joining us. I really appreciate it. Let's have a quick look at the North American markets before we go. Both the Nasdaq Composite and the S&P 500 hitting new record highs today. Nasdaq Composite within striking distance of the 25,000 benchmark. Maybe we could have another quick look at Intel. That stock surging. Apparently, actual central processing units in computers, not just graphics processing units, are important to AI. And Intel finally topping its level during the dot-com era. I guess in inflation-adjusted terms, you haven't done that well on the stock. Thank you so much for watching Trading Day. Have a great weekend.